This is Mr. Harrison. In this video, we're going to talk about taking information from the completed journal and posting it into the ledger. We're going to start with our adjusting entries and move on to all of our closing entries. We already kind of informed our journal of what's going on. We've completed this set of new adjusting and closing entries in the journal. So the journal now knows what's up. Now we have to tell the ledger what's up. We're going to start with adjusting entries, move on to closings. So we're going to start with supplies. Supplies right now has a credit of $339. So let's go to supplies, account number 140. The date is the 30th. I like to put an ADJ right here just so I can discern that this is an adjusting entry. There's a credit right here of $339, which will lower this debit amount by the credit of $339. So we have a remaining amount of $1,284 worth of supplies. This credit represents the supplies amount going down because it got used up. We used up $339 worth of supplies. Next up is supplies expense, $339 debit. So we're going to find supplies expense. There it is. This is an adjusting entry, and there's a debit of $339. And that becomes our debit balance. Next up, we have PPI, or prepaid insurance. So we're going to go find prepaid insurance. There it is. The date is the 30th. This is an adjusting entry. Prepaid insurance has a credit of $200. That lowers our debit total from $900 to $700 because we used up $200 worth of insurance, or it expired. So what we have left, $700. That's our balance of prepaid insurance. The corresponding debit to that is in insurance expense. And our adjusting entries are now complete. Now that these adjusting entries have been completed, let's move on to our closing entries. The first thing we got to do in our closing entry is bring sales to 0. So we're going to do exactly that. We're going to find sales, which is account number 410. And we're going to put in a debit amount. So you can see we have debit, $8,472 for the sales account. So the date is the 30th. This is a closing entry, so I'm just going to put a CL right there. And we have a debit amount of $8,472. Now, as you can see, we have a pre-made balance here of a credit, $8,472. So this debit coming in will cancel both of those out. And we are good there. So sales is brought to 0. Now we have income summary getting this credit of $8,472. So we're going to put a credit amount and balance in there for $8,472 for sales and income summary. Those are done. Now we're going to do all of our expenses. So all of our expenses have been taken from the journal and posted into the ledger. As you can see, we have 1, 2, 3, 4, 5, 6, 7 different types of expenses, each of them in the journal here with a credit amount. These amounts bring each expense total to 0, and here's what I mean. So advertising expense had a balance as of November 30th of $650 in the debit column. So this $650 credit, this closing entry, basically brings in this credit amount, which cancels out the debit amount and leaves us with a balance of 0. That's what I mean by bringing each expense account to 0. We did that for each of these expenses. So let's take a look at insurance expense. The adjusting entry put in an amount in the debit column of $200, and that became our $200 debit balance. The closing entry then is a $200 credit. So that credit comes in, cancels it out, and brings insurance expense back to 0. Same with miscellaneous expense and rent expense, as you can see here. Every single one of these is a closing entry, and we're just taking the credits from this column here in the journal and bringing these credits in. You'll notice that every single one of these credits will balance out and cancel out these debit pre-made balances, and we're going to be left with 0. By the way, password for this video, Maple Leaf, all right, as in the Canadian flag. All right, rent expense, repair expense, supplies expense, similar deal as insurance expense. We have our adjusting entry, which kind of established this debit balance of $339. The supplies expense then brought in a credit of $339 and brought this expense back to 0. Same with utilities expense at the bottom here. We have a 0 balance, as we should. So all of these expenses are now complete. All right, the next thing is we have to put in our income summary here of $4,684. Where am I getting that number? Well, that is simply all of these expenses combined. If you add up all these, you're going to get $4,684. So that's our income summary, which is only there to maintain equality in the journal in terms of debits and credits. So income summary, we have a debit amount of $4,684. That will lower our credit total to the formula $3,788. If that number looks familiar, it should. So income summary is done. Every time we get one of these done, we're just going to highlight it in yellow. So we have two more transactions, 4 more accounts. We got a net income, right? That net income increases owner capital. In this case, the net income amount was $3,788. So the owner's capital increases by $3,788. So let's go to owner capital. That's going to be account number 310. And we have a debit here of $3,788, which will then add to the already there credit balance of $12,100. We add these two together to get $15,888. Remember, when we have a debit and a credit, we take the difference between the two. When we have a credit and then another credit coming in, we're going to add like amounts. So, in order to cancel out this in the journal, we need a debit part. The debit part is in the income summary here. A debit of $3,788. We already have a credit balance here of $3,788. So guess what these balance totals are? They are 0. So income summary in and of itself is a temporary account with a current balance of 0 now that we have zeroed it out. So notice that the combined debits and credits will equal 0. And that's good. That's now been brought to 0 as well. All right, these two are done. Let's highlight them and get them out of the way. And finally, owner capital goes down by the amount of owner drawing, because when you draw money out of the business, you basically take away your interest from the business. You take away the worth of the business when you take cash out of it. So in this case, $460 was taken out of the business throughout the month. We have to bring owner drawing to 0, and we have to lower owner capital by the amount that was drawn out. So we have these two accounts here that we have to deal with. First one is the capital account. We're going to lessen it by $460. So we still have a credit amount, obviously, but we're going to subtract it since we have a debit coming in. So we got $15,428. And then we just finish up with drawing. Drawing obviously is a temporary account, which means it needs to be brought to 0. We have a credit in the journal of $460, which will cancel out with the debit total we have already. And now our drawing is brought to 0. So what have we accomplished by doing this? Well, sales, all expenses, and owner drawing and income summary have all been brought to 0 as a result of placing these entries into the ledger. We've placed them into the ledger just as they appear here in the journal. If it's a debit here in the journal in these entries, then it's a debit in the ledger. If it's a credit in the journal, then it's a credit in the ledger. The idea is to get those 4 temporary accounts to 0, which we have done. And that's about it as far as posting information from journal to ledger. Next video, we're going to talk about the post-closing trial balance.